Hey class, this is our video lecture for chapter 3 where we're learning to calculate the gain or loss on the disposition of property. So let's review from a previous accounting class how it relates to our current tax class. So if you remember in your accounting class back in Accounting 201 or Financial Intermediate, you learned to prepare a company's income statement where we had the different ways of making money, revenue, and minusing out the cost that was used up or expenses to get the company's net income or net loss. And we've done a similar calculation back in chapter 1 where we were filling out a sole proprietorship's Schedule C, and the same calculation would be the company's income minus the deductions to get the business's net profit. And when you fill out a Form 1040, same type of concept where you have income. Now, one of the income items would be the profit coming from your Schedule C, or possibly minusing out a Schedule C's net loss. And you would combine that with the other income of the taxpayer, minusing out other deductions, not business ones that we had deducted back here on Schedule C, to get the taxpayer's taxable income. Sorry for my handwriting. I don't have a stylus that's working right now. I'm using my fingernail. Taxable income. Okay. So now what we're going to do is the same calculation. Maybe some type of income or revenue or sales and minusing out the related costs to get a profit or loss. But the thing we're selling is not inventory or not selling our services, but what we're selling is an investment or maybe an asset we bought for our business that we use for things like equipment or automobile or even a building, and we're using it up, depreciating it like we learned in the last chapter. Then we're selling it. Okay, we're not in the business of buying and selling investments. We're not in the business of buying and selling equipment. We use equipment in our business. We use an office building in our business, but we're not in the business of buying and selling those items. But we still go through a similar calculation. So that calculation is we're going to sell the item. Here's the amount we're going to get, the sales price. And when you sell an item, you will incur costs for making that sale. Things like advertising, maybe a selling commission, maybe legal fees to draft up documents. All of that are called selling expenses, and that comes off the top from the sales price. And the remainder is called an amount realized. Okay, that's after subtracting out just the selling expenses, not the cost of the item you're selling. Now, the next thing we do is subtract out the cost of what we're selling. So you get that initial cost basis, possibly what you paid for, but we'll see other types of initial costs maybe in the next slideshow. And we're going to subtract out the amount of depreciation that was claimed or should have been claimed over the time you've held that asset. In the case of an investment, you probably didn't depreciate it, so the remainder or the book value or the tax term, what's left over, is called adjusted basis. I believe we've seen this term back in chapter 2. And we're going to subtract this adjusted basis from the amount realized to get a gain if the amount realized is bigger than the adjusted basis, or a loss if the adjusted basis is bigger than the amount realized. Now, maybe this is the sales price of your automobile you're trying to get rid of. And here is the fee you had to pay for advertising. And here's the difference remaining. Here's the original cost you bought the automobile at. And the accumulated depreciation all the way through the time you disposed of that asset, selling it, this auto here, leaving this amount of cost that was not depreciated. And we take the difference between the two to either get a gain or a loss. Now let's say you need to do the journal entry for this. You go back to your accounting tool on or your intermediate financial. This sales price here probably would be cash you're collecting. That's the simplest situation. So remember, journal entries debit and credit. And if you're receiving cash, you're going to be debiting that asset, increasing the cash you receive. Selling expenses, I could just reduce the cash amount that's being debited, but I can record this as an expense. Selling expense, we know expenses are recorded with debits. And then amount realized is not journalized, it's just the difference between cash and selling expenses. And costs. The cost is the asset that was set up when we first bought or acquired the asset. Now you're getting rid of that asset when you sell it, so that's an asset being decreased for its initial cost, initial amount, with a credit. And then the accumulated depreciation, we know we've been crediting that contra asset over its life. Now you got to get rid of that related account with a debit. So if I add up all my debits and subtract out this credits, probably it's not going to be equal. If it's equal, that means you broke even on this sale. If you have more debits than credits, that means you need more credits here on the right side. And credits here would be like revenue. Revenue is recorded with a credit. That's a gain account. Or if you need more debits to balance off, that would be a loss being debited like an expense. So here's the journal entry you would record if you were journalizing this sale of an investment or of a asset that you were using in your business. So this gain or loss amount, let's go back to the previous slide, would be income on your tax return or revenue on your income statement. Or if you had a loss, the loss is really like a negative revenue, yeah, negative income up here on the income statement, not truly a deduction or expense. But we go through this calculation here, and we're going to see some of the forms when we dispose of our investments, the tax forms, or dispose of what we call business Section 1231 assets. So let's go through a situation maybe you're familiar with, or your parents are familiar with, or someone you know is familiar with. And let's start off by that thing, that equation that we had learned way back in our first accounting class. If you remember, assets are equal to, what was it now? What's that L? What's this two letters here, right? Everything you own is equal to everything you owe plus the interest of the owner. Or I could rewrite it as assets minus liabilities equals the equity. And you can apply this to a whole company, or you can apply this to a specific asset. So here's the asset I want to work with. You know that house you're living in right now that you hopefully own or plan to own, okay? And it has a value. So let's call that value fair market value. And hopefully it's going to increase every year. Hopefully you don't pay too much real property tax because of that. Maybe the fair market value is more than the costs you had paid for that you had paid. Yeah. And then if you subtract out your mortgage, hopefully the mortgage balance goes down every year because you make monthly payments on your mortgage. That means what's left over, the equity in that house is increasing. So technically, if you were to sell this house, you'll get this value minusing paying back the bank this amount of the mortgage, and you get to keep this equity. Of course, after paying off all of those selling expenses. But this equity is not necessarily equal to the gain or possibly even the loss you would have when you sell the property. So again, let's go through that gain and loss formula. So the fair market value is the sales price. Let's assume that. And you reduce it by the selling expenses to get the amount realized. And then you minus out the cost of that house, or the cost basis, to get the gain or the loss. Okay, so this gain and loss down here is not necessarily equal to the equity or the amount of cash you get if you sell the house. You gotta go through this gain and loss formula to figure out the taxable gain, or what we call the realized gain. When you sell something, when you exchange something, when you get rid of something, there's going to be a realized gain or loss. Now, if you didn't sell this house, you have a potential gain or loss, and we call that unrealized. Only when you sell that asset, sell your house, now is that gain or loss realized. Another term we're going to see is this word called recognized. Recognized. Recognized means the gain or loss that was realized now has to be reported on the tax return. So gains are going to be taxed. Probably losses are going to be deductible. Now, it is possible that a realized gain or loss is going to be unrecognized, meaning the gain is going to be tax-free. Now, how good is that? One example would be when you sell your personal residence and have been living there, owning the property for a few years, possibly up to 250 or $500,000 worth of the gain could be tax-free, unrecognized, even though you sold it and realized an economic gain. Now, if you sell that house at a loss, well, that's a sad economic situation. And what makes it even sadder is that this realized loss is unrecognized for tax purposes, because when you sell a personal use asset, any losses are not deductible. Okay? We're going to see business assets that are sold at a loss are deductible, maybe up to certain limits, and maybe deferred to different years or future years. Okay, let's move on here. So here's some of that definitions again we saw in the previous slide. So all the value you're getting, the cash you receive, the value of other stuff that you receive, even if the person buying your property takes over the loans you owe, it's almost like the buyer giving you cash and they're now borrowing money from someplace else, maybe borrowing from the lender that you had borrowed money from. And then you minus out those selling expenses, and what's left over is called the amount realized. The other term we had learned is called adjusted basis. And again, this is something we've seen back in the previous chapter too, where we start off with the initial basis and then we start to depreciate it, start to use it up over the time we own it. That's called accumulated depreciation. Notice see the term here. That's the amount that was allowed. Allowed means that the depreciation was actually claimed as a deduction on the tax return, or the amount allowable, the amount that should have been claimed. For tax purposes, you gotta claim the larger of the two, report the larger of the two in your accumulated depreciation, reducing the adjusted basis. Now, if you didn't claim all the depreciation you're supposed to in the previous year, you probably should go back and amend those open years. So increasing the amount of benefit, because you have to reduce this adjusted basis by the amount that was allowable. If a year that you should have claimed is now closed due to statute of limitations, there may be some accounting methods you can adopt to take that missing depreciation in the current year. Okay, so that's a topic not covered in our chapter here. Okay, so you got your adjusted basis now. You figured out the amount realized in the previous slide, and we take now the difference between the two. That's the amount realized minus that adjusted basis to get that gain if the amount realized is bigger than the adjusted basis, or a loss if the adjusted basis is bigger than the amount realized. Keeping in mind this gain or loss is categorized as realized versus recognized. That's really the maybe the last part of our chapter 3. And if you didn't sell it but have the potential of a gain or loss, remember we call that unrealized. When you sell it, when you dispose of the asset, now that gain or loss is realized. Here's some examples of calculating the amount of gain or loss realized. And we have different types of assets like we had seen back in the previous chapter. Here are the personal property, and here is real property. We have the amount realized, which is already subtracting out the selling expenses. We have the initial cost basis and all the depreciation that was allowed or allowable through the time we dispose of these assets. Keeping in mind, if you're taking depreciation, you have to know the depreciation convention, like if it's mid-month for real property, or is it the half-year or mid-quarter convention for the personal property. So that's going to be a depreciation all the way through the year you have those assets. Then initial basis minus accumulated depreciation equals the leftover costs, or the adjusted basis. And the amount realized minus the adjusted basis, like we've seen in the previous slide, equals the gain or the loss. Now these gains or loss are probably going to be recognized, but based upon the character of the gain or the loss. And that's really the complex thing in this chapter. We're going to have to classify them into different types. Different types of gains may be taxable. Most of them are. Could be tax-free. Remember, that's unrecognized. Could be taxed at low rates or high rates, ordinary rates. Losses could be recognized or unrecognized. The losses could be deductible now, or limited to a certain dollar amount and carried over to future years, or maybe even carrying it back to a previous year. So that's the complex part of this chapter, which we'll see in the next slideshow, or 2 slideshows from now. So here's that R word again. Remember, recognize means you're reporting it on the tax return and you're paying tax on the gain. Or you're reporting this loss on the tax return and deducting it and saving taxes. Versus realize. Again, realize means you sold it. Recognize means you're reporting it on your return. Okay, let's stop here and continue with the next part 2 of this chapter 3 video lecture.